Hi, I'm Tim Steffen, Director of Advanced Planning at Baird. You may have heard a lot of talk recently about the potential for some significant tax law changes taking effect in a couple of years. Today I want to spend some time explaining the backstory to those changes, what some of those changes are and who may be affected by them, and things you can do today to begin planning for those changes. In 2017, Congress passed a series of tax law changes called the Tax Cuts and Jobs Act, or TCJA. The primary focus of this bill was changing how income is taxed for individuals and businesses. But today I want to focus on a different aspect of that bill, an increase to the lifetime gift and estate tax exemption amount, a change that dramatically reduced the number of people subject to the federal estate tax. This increased exemption amount comes with a sunset, however, meaning high net worth individuals are facing a limited window of time to take advantage of a significant wealth transfer opportunity. Before we go any further, let's take a step back and explain what exactly is the federal estate tax and the importance of the lifetime exemption amount. At your death, the federal government imposes a tax on the value of your estate. Today, that tax rate is 40%, but fortunately any transfers to a surviving spouse or to charity are completely exempt from the tax. There's also something called the lifetime exemption amount, which is a specific dollar amount that can be transferred either during your lifetime or at death and also remains exempt from the tax. For 2024, this exemption amount is $13.61 million per person. So for a married couple, more than $27 million combined. With expected inflation adjustments over the next couple of years, this amount could hit as much as $15 million in 2026, or $30 million for a married couple. But this is where the potential changes come into play and why it's important to talk to your Baird advisor now. This increased exemption amount is scheduled to sunset after 2025. And in 2026, the exemption amount is expected to fall by more than half, to something closer to $7 million for an individual and $14 million for a couple. If this exemption does fall as scheduled, an individual could be facing an extra estate tax liability of more than $3 million. And for a married couple, it could mean more than $6 million in additional tax. If there's one thing we know for certain when it comes to taxes, it's that there's no such thing as a permanent tax law. Any law can change at any time depending on who's in control in Washington. And while this expanded estate exemption is scheduled to sunset in a couple of years, there's no guarantee that will happen. Congress could choose to leave this elevated exemption amount in place, or they could pick a different amount between where it is now and what it's expected to fall to. With an upcoming presidential election and the possibility of entirely new leadership in Washington, it's impossible to predict where this number might land. Because of this uncertainty, our planning advice varies across 3 different scenarios. Let's begin with a couple at the lower end of that range, with a net worth below the expected $14 million combined exemption amount, or a single individual with less than half that. Even if the exemption amount does fall to this lower level, this group should have very little concern over the federal estate tax. Government data shows this represents 99% of all households in the country. So for the vast majority of Americans, significant planning around the federal estate tax liability should not be a priority. However, having a current estate plan with updated beneficiary designations, healthcare directives, and other important planning tools is still very important. Planning for the estate tax liability may not be important, but having a good overall estate plan is still necessary. At the other end of the spectrum, we have married couples with a net worth of more than $30 million, or a single individual with more than $15 million. This group is already facing some level of estate tax liability today, and that burden will only grow if these changes do in fact happen. As a result, this group should already be talking to their estate tax attorney and other planners, as well as their Baird financial advisors, to come up with a way to manage this tax liability. For this group, it's unlikely the estate tax exemption will ever be large enough to eliminate the need for estate tax planning. Our third scenario is for that group in the middle, a married couple with a net worth between $14 and $30 million, or a single individual between $7 and $15 million. Today, this group has very little concern over the estate tax. But if these changes do happen, this group could be facing a multi-million-dollar tax liability. This is the group that has the most to discuss with their Baird financial advisor, because failing to take action could be very expensive, but overreacting could limit your financial flexibility into the future. Another reason why planning around this potential change is so essential is because of what it takes to actually use the exemption before it sunsets. To illustrate this, consider a married couple that would like to take advantage of the expiring estate tax exemption before it sunsets after 2025. They assume the exemption will fall from $15 million per person to just $7 million, and they want to find a way to use the portion that would go away. What looks to be the obvious answer would be for each spouse to make gifts to their kids or others today and allocate them to the sunsetting exemption, while saving the rest of their exemption for transfers later in life or at death. However, the gift and estate tax rules don't allow you to do that. Instead, transfers you make today are first allocated to whatever exemption is in place at your death. If lifetime gifts don't exceed that amount, the sunset amount is lost. If your lifetime transfers exceed that amount, then excess gifts can be used against the expired amount. However, in order for those excess transfers to be allocated in that way, they first must be completed before the expiration or sunsetting of the exemption happens. So what this all means is that to take advantage of the $8 million of exemption that might be sunsetting, you first have to transfer out the $7 million of exemption that would remain in place. As you can see, this can be a significant transaction and one that requires a lot of advanced planning. And while a sunset in 2026 may seem like a long way out, beginning those discussions now with your Baird financial advisor will give you the most time to analyze and consider the options available to you. For example, annual gifting or purchasing life insurance might be easier to implement, but using some advanced trust strategies like implementing a SLAT or a spousal lifetime access trust, or transferring business interests that may require an independent valuation can be much more involved and take more time to implement. Fortunately, your planning team here at Baird is ready to help. Your Baird financial advisor has access to resources and experts, including our advanced estate planning and wealth strategy teams, trust strategists, and business owner solutions group that are available to discuss and analyze options available for you. And then meeting with your outside tax and legal advisors, we can put together a plan that's appropriate for your situation. So whether you're concerned about a potential future estate tax liability or something today, or maybe just want to review your documents to make sure they're appropriate for your family situation, your Baird financial advisor and our planning team are ready to help. We look forward to working with you on these important planning issues.